Hello everyone, welcome to a new video. It has already been now a few months since I stopped focusing on buying only dividend stocks. And this is not me saying that I don't buy any more stocks that pay dividends, absolutely not, but it's simply that I do not care about this metric anymore. I mean, I care if I think that maybe the fact that they pay a dividend that maybe it's too high can harm the company or the stock price of the company in the long term, because maybe they will have to cut it or simply it's not sustainable and it's just damaging the core business. Then yes, I do care, but other than that, it's not a metric that I look at anymore. In this video, I will be explaining why I made this change from 1 year ago, in which I was filtering and only selecting stocks that were paying dividends, to now having removed completely this metric from my analysis to determine whether I want or not to invest in a stock. And with that said, and after I remind you that all of this video will be done from a long-term investor perspective like myself, let's go and check out the reasons for my shift. The first and most important reason for it has been the fact that I realized that for wanting or filtering just for dividend stocks, I was missing out on other companies that I really liked, that I thought that they had great future potential simply because they were not paying dividends. And now I don't want to come here as I pretend everything, absolutely not. I'm doing precisely this video because it helps me also record and basically keep track of my progress over time and how I learn and evolve. But Tesla, for instance, was a company that, okay, now you will say, oh yeah, it has run up a lot in price. You can believe whatever you want. It's a company that I really liked in the past, more than 1 year ago, before it ran up crazy in price. I also like today, so it's not like I stopped liking it. Maybe I think that the valuation is a bit too much, too expensive, but still it's a company that I really like. And I never invested in it simply because it was not paying dividends. Of course, now it's very easy to say this because it has run up in price, but the truth is that I really like this company. And again, this was just to put an example. The thing is that at the end of the day, the dividend is something to, of course, keep in mind, but it should never determine whether you invest or not in a stock, and there are many other factors that are much more important. Let's just say, for instance, the sales, the margins, the industry that the company is in, the competitive advantage that it has versus its competitors. I know that there are many other factors. That then on top of that, it pays dividend. Great! You are investing in a company that has great future potential, and on top of that, you're getting some cash flow for it. But as I said, I think that you should always, or at least my takeaways is that I should always focus on investing on great companies that I think that will do great in the future. Also, another big argument in my case is the fact that I honestly don't need the cash flow from the dividends. I have a full-time job, and anyways, what I do when I collect the dividends is to reinvest them into the market. Sometimes I reinvest them in the same company, sometimes in other companies. But I basically take these dividends and put them again in the market, which is quite stupid because I basically pay taxes for it and then I put them again in the market. Instead, it would be best if the company would already keep these profits inside it and use it to make it grow even more, and then this would have a positive effect also on the share price, and my shares would basically increase, and with it also my net worth, without me having to pay taxes for it, which is just a much better alternative. On this, I also must say that a big reason for me stopping to buy dividend stocks is determined by my current age, because I'm 22 years old and hopefully I still have many more years to live and to also grow my portfolio. If maybe I was 40 to 50 years old and I was getting ready for retirement, assuming that I wanted to retire at the normal age of 65 years old, then yes, maybe I would be looking more for dividend paying stocks to get some cash flow to hopefully also help me sustain my style of living once I retire. But since it is not the case, I, as I said, hopefully have many years to come. What I want is my portfolio to grow as much as possible, which also means that I maybe focus more on growth stocks that in the next 10, 20 or I don't know, 30 years will hopefully multiply its value by 5, 10 or more times, and that will hopefully make me rich or hopefully retire early someday. The next argument for my shift has been the fact that if you think about it, for a company to start paying dividends, it means that it is already at a stage in their, let's say, company life in which it is already having relatively stable revenues and also profits, and they can ensure that they can pay dividends, sustain, and also hopefully increase them over time. Also, if they decide to pay dividends, it also means that somehow they think that they cannot use this money to help the company grow even more, maybe because they are already at the stage in life in which the company is very consolidated. Again, if I was the owner or if I had a major stake in a company like this, I would also probably like to have some dividends and cash flow, as it would be enough probably to sustain my style of living, and I would not have to sell my shares every time I needed money. But certainly, as I said, I'm not in this stage in life, and what I want is for my money to grow as much as possible. So that's what I try to focus more, let's say, on just stocks that can grow over time. Also linked to this, and commenting a bit more on what I was mentioning, that usually companies that start paying dividends are usually much more well established and the future growth perspectives are not that good. Let's just compare two different companies. We will have Coca-Cola, that I think is a very popular one, also with Airbnb, that actually just started trading on the stock market this past December. And we have on the one hand Coca-Cola, which has been paying dividends I think for 58 years in a row and increasing them, so I mean crazy. But that probably, how much will it grow in year over year? 5%? 10% if we are being very optimistic. I mean, just in the past years it has even struggled to, keep up the sales and the same amount of them, because it has already expanded pretty much everywhere in the world, so it's also very hard for it to increase that top line more. And on the other hand, we have, as I said, Airbnb, that it does not pay absolutely any dividend, but that it was only founded in 2008, so it's relatively, let's say, a new company, and it certainly has a massive potential ahead of it, or at least that's my perspective, and I think that it would not be surprising to see it growing revenues at 40%, 50%, even more than that year over year. So while it might not be paying dividends, the growth perspectives looking into the future are much different. Of course, in this we should also consider other aspects, such as the risk, tolerance that we are willing to take, because of course it's much more risky to invest in Airbnb than in Coca-Cola, but I hope that this illustrated my point. Additionally, commenting a bit on this risk factor, you can also find yourself investing in very well-established companies that already reached its peak, that have very little growth ahead of them, and maybe little by little smaller competitors that are more innovative start taking market share from this large company. And yes, you might find yourself collecting these dividends, but at the same time that you are collecting dividends, your stock price probably will go down. Again, this does not necessarily have to happen, but it's just, of course, a risk that you also have when investing in, let's say, more well-established companies. And as a final argument for my switch in strategy, we also have that the fact that you invest now in a company that does not pay dividends does not mean that they will not start paying them in 5, 10, 15 or 20 years. Maybe now they are still at a very growth stage in which they are focusing, as I said, on growth, but maybe they reach a point in which they decide to start paying dividends. Then you might find that you have bought shares at a very low cost basis, because it was still when they were at the growth phase, that now they are worth much more, and that the dividend that they pay, it gives you a very high yield. So this again might be very positive, because maybe now, for instance, in my case, I don't want the dividends, but maybe in 15 years I decide to retire, and then it's perfect if the company then starts paying them. Concluding and giving my main takeaways from all of these, we have that if you invest in a company, it must be because you have analyzed it properly, you really trust in it, and you are convinced that it will do great in the future. And the fact that it pays or not dividends should not play a role on your decision. Unless, as we said at the beginning, these dividends have a negative impact on the company and they are harming it. In any case, this was the end of the video. These are my thoughts and reasonings behind my switch in strategy. And remember that I'm no financial advisor, that I do this video just for myself, for fun, that you should take it for entertainment purposes, and that for me it helps me have these videos to kind of like keep track of my progress over time, and then look back in, I don't know, 10 years or 5 years and see how have I progressed. In any case, if you enjoyed the video, then don't forget to give it a like, subscribe to the channel if you are not yet subscribed, and as always, see you next time.